Hi everyone, in this video I'll be guiding you on how to prepare a question on effects of transaction on the accounting equation. If there's one thing you must know about this kind of question, is that assets is always equals to liabilities plus equity. So how you're going to do this is basically simple. Looking at the example, whenever you see such transactions, always highlight the important keywords. So here, when you see the owner brought into the business $5,000 by cash, the keywords are owner brought into the business, and what did he bring in? He brought in cash. So we need to convert these keywords into proper account names. So in this case, when the owner brought, that means owner contributed into the business, we are going to write this account as capital. Next, the cash that he contributes, we will classify this as cash in hand. And knowing the classification, cash in hand is under assets, whereas capital is under equity. Next, you determine what is the effects on the assets. Does it increase or reduce it? In this case, because there's more cash into the business will have plus $5,000. On the other hand, for capital, because the owner contributed money into the business receives more contribution from the owner, so it will actually increase equity by $5,000 as well. Alright, let's look at the rest of the 4 transactions and try to answer them. Always look for the keywords again. So here, Marlene took a pair of sports shoes costing $100 from the store for her own use. First off, you need to identify who is Marlene. In this case, Marlene is the owner of the business based on the first sentence given in the question. So always read the question, the background of the story of the business, because that will guide you a lot. And one more thing, this is a business in sportswear, so these sports shoes are actually your inventory. So here we go, Marlene taking a pair. So keywords, Marlene took a pair of sports shoes, and in this case it is for her own use. So this time around, it is the reverse of the example here. Marlene taking out sports shoes is actually owner's withdrawal. So we need to find a proper account name. In this case, it is drawings, and we will also write it under the equity column. And what did she take out from the business? It is sports shoes, but we can't write sports shoes. So we're going to convert this and write the proper account name called inventory. Next, decide whether it is a plus or minus on the assets. So since sports shoes were taken out from the business would have lesser assets now. So we will actually minus $100. How about equity? Since the owner took out from the business now owes lesser to the owner, so we will actually minus $100 as well. Now, a couple of students have this tendency to write plus $100 instead. Yes, there are more drawings, so students tend to think that because there are more drawings, they will plus the $100. However, you always have to think in the perspective of the equity itself. While there is increase in drawings, the effect on equity is such that it reduces the equity. So it is an indirect relationship. So drawings is one of those odd one out that will cause equity to reduce when it increases. So moving along, in transaction number 2, the business returned defective goods to the supplier previously bought on credit. So let's give the supplier name Tim. Alright, because whenever there are credit transactions, you need to have names for the supplier or customers. So here, when the business returned defective goods, and it was initially bought on credit basis, you need to think of the 2 accounts. Obviously, we have inventory here because of the word goods, so we are going to write inventory under assets. The other one, our supplier, Tim. Supplier is always a payable. So in this case, because we bought goods from him, we will be using trade payable, because we will be paying to Tim in the future. Now next, think of what is the effect on the assets and liabilities. In this case, because we returned the inventory to the supplier, our assets, the business assets, actually goes down. And since the business returned to Tim, the business now owes to the credit supplier lesser as well. So we will actually minus our liabilities. Alright, now for those empty ones, we're just gonna write nil. I hope it's okay for you so far and you are able to follow it. Now in transaction number 3, the business bought a new cash register on credit basis. Let's say we buy from Ellie. Right? So when we buy from Ellie, does this make Ellie our customer or supplier? Ellie is actually our supplier. But this time around, because we bought from Ellie something that is not in an inventory, we can't use trade payable. We need to use the other account, very close to the trade payable account, is what we call other payable. And this new cash register, we need to find a suitable account name for it. Let's call it equipment. Alright, now that you've identified the two accounts, what is the effect on assets and liabilities? Since we have a new cash register, the business will have an increase in assets by 820. And since we bought from Ellie on credit basis, we actually owe Ellie money. We haven't paid her yet. So we are going to increase our liabilities as well. Alright. So the last but not least, last transaction here, selling goods. 2,300 on credit, full stop, and then cost of price of the goods was 1,800. So be careful. These two sentences with two separate amounts, we need to have 4 accounts. Anytime you sell goods to a customer, we will have 4 accounts. So let's identify the first 2 accounts. When we sell goods on credit, let's give it a name to Ali. So we sell to Ali, meaning we don't receive money from Ali immediately. We will classify Ali as a trade receivable. Every time we sell to a customer on a credit basis, we will write the account trade receivable because we expect to collect money from our customer in the future. And because we sell, we are going to increase our equity. Alright, now, because equity is made up of 4 things, besides capital, it is also made up of income. And what reduces it is drawings, like it was mentioned in first transaction, and also expenses, which you will see in a while. So now that we have identified the accounts, decide whether assets increase or decrease. In this case, we have customers owing us money, so we will actually increase our assets by 2,300. Also, since we make some sales, we receive income, so the business would now have more equity. But that's not all. We still have the cost price of the goods. So the cost price refers to the original price of the goods, because technically and logically speaking, we need to buy some goods first before we are able to sell them away. So we need to actually recognize that there was some inventory going out of the business. Now every time you sell inventory, it is sort of converted from an asset to become an expense. So this expense is what we call the cost of sales, and it is under the equity column. Next, let's decide whether the assets goes up or goes down because inventory is being sold away. Now if you think of it, since inventory was removed from the business, we will actually minus away the 1,800. Here, cost of sales is an expense. Yes, it increased, but it has got an indirect relationship with equity. So since expense increased, your equity will actually go down as well. So do take note, cost of sales, which is an expense, and drawings, while they both increased, the effect on the equity is decreased. So there you go. I hope this is a simple guide for you to do your other questions on effects of transactions on the accounting equation.